Good afternoon. I'm Claire Kramer-Mills from the Fed's Community Development Team. Welcome to the fourth webinar in the New York Fed's policy series on inequality. It's my pleasure to moderate today's event. The views I express are my own and do not necessarily reflect those of the New York Fed or the Federal Reserve System. A few housekeeping notes as we begin the event. This event is being recorded and will be hosted on our New York Fed event webpage. As a reminder to all speakers, this event is open to the media, so all remarks and presentations are on the record. All attendees will be in listen-only mode. The viewing options are on the top of your screen on the right-hand corner. This will be a 1.5-hour webinar, and because of time constraints, there will be no Q&A. For follow-up questions, please visit our event website. We realize that this is a limited time. Our goal is to advance the conversation on evictions and to discuss possible solutions as the pandemic stretches on. This event will feature two panels. Panel 1 will delve into sizing the issue, who's in crisis, data on renters and landlords. Panel 2 will focus on options for relief, remedies, costs, and risks, and will be moderated by Mark Willis, Senior Policy Fellow at NYU Furman Center. We want to thank NYU Furman Center for collaborating on this event and partnering with us on it. We'll begin with opening remarks by Denise Scott, Executive Vice President of the Local Initiative Support Corporation and Chair of the Board of Directors of the New York Fed. Denise, we thank you so much for helping to frame the discussion and teeing us up today, and I'll turn it over to you.
Thank you, Claire, and hello, everyone. Thank you all for joining us. This is a very timely and important discussion. I want to thank David and the team for pulling us together and for the work that I know that they're committed to as we move forward. I want to share the thoughts that I have as we open this conversation and look forward to hearing all that you all have to say. I see many of my friends and colleagues on the panel. When we look back at 2020 and the heartbreaking loss of life, businesses, jobs, and family experiences of these recent months, our national failure to enact clear housing solutions in face of COVID seem inexplicable. Renters and landlords are in deep trouble. We are 8 months into this crisis and no resolution in sight, and families are having to choose between paying for housing or for food and other necessities. It is clear from both data and experience what needs to be done. We need significant federal resources, including emergency rental assistance, resources to ensure that affordable housing providers can weather the crises, or we're going to have a housing crisis that will dwarf what happened in 2008 and 9. Millions of renters are only protected from eviction by the CDC's moratorium, which expires on December 31st. However, they are not protected from the long-term risk of housing loss that will come when their back payments are due. According to various predictions, upwards of 40 million renters are at risk of eviction in the coming months, which is about 25% of this country's renter population. It's also estimated that renters may owe as much as $35 billion in back rent by the end of the year. Among renters in Class C properties who are predominantly lower wage workers and their families, only 12% paid their rent in full on October 1st. If evicted, the loss of income to these households, especially in communities of color, where many homeowners and others never fully recovered from the last economic downturn, will impact generations to come. Just as COVID-19 is having a disproportionate impact on the health of Black and Brown families, so too is it exacerbating our racial wealth gap, which already saps so much of our national potential. Landlords are also being impacted, especially ones that own small multifamily buildings that offer affordable rents to families and seniors. Without reliable rental payments, landlords are unable to pay their mortgage and other bills related to the upkeep of their properties, putting their affordable properties and residents at risk. The shortfall in income is likely to result in deferred maintenance, affecting residents' safety, and should a landlord end up in foreclosure, all of their tenants could end up facing eviction, whether they're current on their rent or not, as lenders take over the property and others swoop in to take property over as well. The same ripple effect also extends to community lenders, often the primary source of financing to underserved communities. As their borrowers are unable to make loan payments, they will struggle to provide ongoing financing for businesses, real estate development, home purchases, and all of which is critical to community economic recovery in the months ahead. In conclusion, we are at a place of a massive eviction crisis, which will disproportionately impact people, as we said, living in low-income communities, as well as communities of color with the far-reaching impacts that I described. We all are at risk of losing a significant amount of unsubsidized affordable housing. And we're even starting at now to begin to see that even the affordable housing, which is the most typically secure housing, is also beginning to face distress due to lower rent collections. Unfortunately, it is doubtful that a large-scale relief effort will arrive before 2021. American families and communities need action now. I am heartened by the New York Fed convening and its focus on this issue, and hope that all of the ideas that we have today can be placed in a way that will have some influence on the decisions that are necessary to have as we go forward. I thank you all again for joining us, and I'm really looking forward, as I know you all are, to our conversations, but especially to what we might be able to determine and influence that can get done as the days move ahead. So thank you all. And Claire, I give the mic back to you.
Thank you so much, Denise, and thank you for those comments, which I think help us really understand the true scope of this crisis. I'm going to now turn to panel one, four esteemed people who are going to help clarify and I think delve into even greater detail to contextualize all of those various and interconnected elements that Denise just spoke about. So I'll begin with the roundup of our four panelists. Brian Byrd, who's a program officer at New York State Health Foundation. Erica Popig, VP and Chief Innovation Officer at the Urban Institute. Matt Murphy, Executive Director at NYU Furman Center. And Randy Pierce, President and CEO of Brooklyn Chamber of Commerce. So welcome to all of you. Let's open the conversation. Brian, I'd like to start with you to help us understand the connections between health and housing, and to delve a little bit even more deeply into who's at risk and the measures that are currently in place to help them. Over to you.
Great. Thank you, Claire. And thank you for everyone who is watching us. I'm very honored to be able to talk about what I call the nexus on housing and health. As we know, as of today, the COVID-19 pandemic has killed more than 225,000 Americans and is arguably considered the worst public health, economic, and national security crisis in more than a century. However, it is also known that the affordable housing and eviction crises have been with us well before the pandemic hit. And so as a statewide foundation or funder, health funder, the New York State Health Foundation believes that the nexus of housing and health is vital to a robust economy and a public health ecosystem. Unstable housing and homelessness are well-documented predictors of poor physical and mental health over a lifetime. And in fact, there are studies that now show that evictions have been linked to increases in depression, drug overdose deaths, and suicide. So as the pandemic rages on, housing and sheltering in place is still considered one of the best defenses in fighting the spread of the COVID-19. Yet people with unstable housing may not be able to shelter in place, and they are also more likely to have chronic medical conditions that put them at higher risk for contracting the virus. Numerous studies of available federal, state, and local data have found that people of color, as Denise had mentioned earlier in her remarks, are experiencing a disproportionate burden of the COVID-19 cases as well as death. And this next slide are just an overview of some of the stats, at least for New York State. So as you can see, Black residents have died, and this is excluding New York City, Black residents have died at 3.8 times the rate of white residents. Hispanic residents, 3.4 times the rate, and Asian residents at 2.1 times the rate of white residents. Now, in New York City, it's a little bit different, but you can see that the trend is still pretty much the same, very consistent. And adults of any age with the following conditions have a greater risk of severe illnesses from COVID-19: cancer, obesity, hypertension, smoking, asthma, diabetes. And as the second wave of the pandemic takes hold, stable housing is now even more critical, but high unemployment and economic hardships have increased housing insecurity among renting families. As you all know, and it was referred to earlier in Denise's comments, Governor Andrew Cuomo and the Centers for Disease Control and Prevention both issued moratoriums on evictions. Governor Cuomo's first issued this back in March of 2020 and recently extended it through the end of the year. And in early September, the CDC issued its own moratorium. Next slide, please. Thank you. Here just is a very simple overview of three moratoriums impacting New Yorkers: Tenant Safe Harbor Act and Governor Cuomo's executive order, the CDC's moratorium, and then this last one, the moratorium on utility terminations, is something that this is a law that was passed and signed into law, rather, legislation that was passed and signed into law by the governor that deals with utilities. Now, these actions basically are intended to stop the spread of the coronavirus and to avoid having renters end up in the streets, in shelters, or in other crowded living conditions, which are known to be, I guess we can say, almost super spreaders of the virus. Now, generally speaking, do they work in protecting vulnerable populations? Well, yes and no, and I'm sure my fellow panelists will go into more detail about this. But the moratoriums are extremely helpful, but certain eviction proceedings can occur and tenants do have to go to court in order to defend themselves. So one of the arguments that I'm hearing and that we are hearing is that instead of solving the problem, a lot of experts are saying that these moratoriums simply kick the can down the road and are setting us up for another economic and public health crisis. And again, why? Because rent has not been waived. It is still due, and renters are still responsible for payment as well as back payment. And when the moratoriums end, that bill is going to be enormous and creating what many of us have described as the eviction tsunami. And with that, I'm going to stop and let my other panelists talk.
Brian, thank you so much. Really, really helpful to give us the sense of the gravity and also the fact that we're really in a holding pattern in essence right now. I'd like to turn to Erica and zooming out a little bit. Can you tell us a little bit, explain how these issues are playing out nationwide, specifically from a tenant perspective, a resident perspective, who is most affected, and as Denise, described in her earlier comments, the situation facing small multi-family landlords. And then I'd also like you to touch on, if you can, the CARES Act and what relief it did provide and any gaps that you could identify in that package. Thanks, Erica.
Great, thanks so much, Claire, and thanks, Denise, for those incredible comments setting this up. And Brian, it's so helpful to follow you and the context that you provided, because COVID is a health crisis that has created an economic crisis, but it's also laid bare what was already the condition for so many low-income people and also Black and Brown households in the country who are now at even greater risk for eviction and homelessness. We know from the US Census Pulse Survey that's been taken almost every week since the beginning of this crisis that a quarter of renters have low confidence in paying next month's rent. And other surveys that track more of a slice of the rental market are reporting that 10% of renters did not pay rent in the last 30 days. But we also know from these national surveys that nearly 40% of Black and Brown renters report low confidence in paying rent. So disproportionately impacted by this crisis. So the Urban Institute has done some analysis to really try to understand the dimensions, how renters are affected by the COVID economic crisis, and using BLS data between February and August 2020, we estimated that 5.3 million renter households suffered a job loss. Now that's about 1 in 8 renter households. But as Brian said, even before we came into this crisis, half of renters were cost burdened and 1/4 were severely cost burdened. So this is just a layering on of the pain. And so we have certainly people who've experienced job loss who are currently feeling threatened by the instability, housing instability. But we know that even before that, people were facing the same kinds of challenges. And what we have is an equity consideration in this crisis as we think about the kind of policy that we're crafting going forward, which I'll get to more in a moment, because most of the policy has been crafted to help provide rental assistance to the people who lost employment in this crisis. And yet we have essential workers who are bagging our groceries or delivering them or collecting our garbage or any number of the things that have enabled us to stay safely at home and in shelter, who are low-wage workers, who are among those households who face housing cost burden. So as we think about the kind of policy that we want to craft going forward, I think it's really important to hold both of these in our minds as we think about the crisis that brought this on. So Urban Institute has sized what it would take to bring down the cost burdens of both those who lost employment and those who were already cost burdened, and has provided that in order to help inform the kind of sizing of the rental assistance that's needed to address those cost burdens in the country. I can come back around to that. But I really want to highlight now perhaps a group that has not been discussed enough in this crisis, because one of the things that's been a little bit harder to figure out is where are the renters who are most at risk living? And what does that mean about the landlords who aren't receiving rent at this time? And how vulnerable are they as individuals, as businesses? So I want to highlight this subgroup and share some data from a survey that has been administered by Avail, which is a service for small landlords, particularly of 2 to 4 unit buildings, and that my colleagues at the Urban Institute and the Housing Finance Policy Center have analyzed. So just generally stepping back, of these kind of small multifamily properties, 2 to 4 unit buildings, there are 6.2 million rental units in these buildings nationwide. That accounts for about 1 in 7 rental units in the US. They're disproportionately in some metropolitan areas, Boston, Chicago, Pittsburgh, LA. I think New York has a fair share even of these smaller properties. These units tend to have lower rents and are commonly owned by what we call mom and pop investors who depend on income from these properties. So this is a really critical subset of the rental market, and one that is likely to feel a huge crunch in the absence of additional rental assistance. Although most of the owners of these buildings are white, they do have a higher share of Black and Hispanic owners, and about 30% are owned by immigrants. And about 1/3 of the landlords surveyed earn the majority of their income from these rental properties. I think that's really important when we think about this. These are small businesses that are the primary source of income for so many households, and often the pathway to wealth accumulation and asset building. So to Denise's point about the racial wealth gap, so much of people's wealth are actually tied up in these rental properties. Black and Hispanic landlords are more likely to own 2 to 4 unit buildings than other kinds of properties, which also means if we think about where the tenants are that are in these properties and who have lost jobs, there's probably a strong connection between the two. At least that's what we're finding in our analysis. Now, only 12% of landlords with a mortgage are in forbearance in this survey, but these landlords are more disproportionately likely to be Black and Hispanic. And they're also tapping into their savings to make it through this particular time. What we also learned through this survey that also Black and Hispanic landlords are more likely to offer rent payment plans to their tenants than white landlords are. And so they're in a position of trying to actually work out deals and keep tenants stably housed, but also keep the tenants for the longer term as well. But they're pulling from savings and other kinds of emergency funds to get by in this particular period. So that just brings me lastly to what is some of the policy that we can be focused on in this moment? What has the CARES Act already done? Well, the CARES Act has made an important investment in rental assistance. And to Brian's point is we have to think about moratorium and rental assistance together, not one or the other. But we're living in a moment now where where the CARES Act money has been allocated and is being spent, where the unemployment insurance has run out for so many people. And we are in a period where we face a potential gap with the moratorium ending at the end of the year. And so it's a critical time to be thinking about rental assistance on the federal agenda and extending that rental assistance further. National Low Income Housing Coalition released a survey that just today, I think, finding that there are now 440 local and state emergency rental programs that have already been started with CARES Act funding that would be ready to go, of course, with new resources. But it's really critical that those resources come through some kind of recovery package. Current deliberations have had that package at about $60 billion, which from Urban Institute's calculations could carry us through about 2 years, just for those renters that had lost their jobs, not taking into account the other vulnerable renters who are part of how we can shelter in place. So I would just echo the other comments that have been made about the need to stabilize renters to prevent other kinds of health consequences that Brian so well laid out. Thank you, Claire.
Erica, thank you so much. And that was a great overview of the issues facing renters and also, the small landlords. So thank you for that. Matt, I want to turn to you to understand specifically how these issues are playing out in New York. Erica noted that you do have sizable shares of small landlords in New York. Obviously, from an affordability perspective, New York, these are issues that are chronic in New York. We've looked at detailed data at the neighborhood level to understand the strains on renters and landlords and neighborhoods. So love to hear from you about what you're seeing on the ground and the data that you've looked at.
Yeah, absolutely. And thank you for having us. Thank you to my fellow panelists who just so well set up all of these issues. I mean, it's just amazing. And I think the commonality that I always think about is just like the magnitude of what we're dealing with is just so tremendous. And of course, in New York, just because of our population and our renter population especially, this is a huge impact on our residents. Echoing what Brian and Erica said, I mean, we had pre-existing issues. We have about almost half of our renters are cost burden in the city. These are also issues outside of the city as well. So I want to talk a little bit, I have a couple slides to show on evictions too, and just thinking about the magnitude of what we're talking about. We do have some, kind of evidence from eviction filing data on what scale we're really talking about. And what the moratoriums really have been able to do. So the black thick line here is the 2020 number of eviction filings, and this is in the thousands per week. And so what you see really is, compared to prior years, obviously you can see when the moratoriums go into place in March. And we are just really functionally zero on filings because of some pockets of policies and law. You started to see an uptick in August and September, and this gives us some evidence of what happened with those filings. Even then, these are not like large numbers of filings. So, given the scale we're talking about, between March 20th and June 19th, which is a period of a moratorium, we would have seen about 39,000 eviction filings in that period, right? So this is like typical activity we would see in New York City. Between June 20th and September 6th, we would have seen about another 43,000 filings. Instead, we saw zero between March 20th and June 19th, and about 7,000 through September. So we're dealing with the consequences of COVID and all the non-payment that we expect because of that and the financial impact. But we're also dealing with like the typical pattern we would have seen. And so these are like mounting concern, because it's, as Brian said, like, and I would describe it too, it is a pushing the can down the road. So going to the next slide, what we also see is some evidence that in prior years, it's been very consistent that eviction filings take place at about when 2 months rent is 2.5 months. A typical filing is somewhere between $3,000 and $4,000 in New York City. And there's not a ton of variation year by year. But what we see in the few filings that did take place is just a dramatically higher amount, right? And so this could be because more expensive units are seeing filings, but I think it's probably more likely that we're seeing the effect of what a moratorium does, which is it pushes out when a filing takes place, and so there is more rent owed because that rent is not paid. So this is kind of building this narrative that we are likely to see when these things expire, just huge amounts of rent owed that's been building in this time period. So then, just thinking of the New York City too, this is obviously not, and we'll go to the next slide, equally distributed throughout the city. It's not like every neighborhood is seeing kind of similar rates. It's actually that when we look at the COVID period here, where we have filings, which is the left-hand side, and compare that to the right-hand side, which is our typical periods of eviction filing rates, it's pretty similar. We actually see a lot of evictions take place in the neighborhoods where we actually have higher COVID rates as well. But we also know that these are areas where there is generally higher concern of housing instability. And of course, there are intense racial disparities too. There are disparities in filing rates across zip code areas, which is the lowest geography we have access to. The areas where we saw the highest third of eviction filings in 2019, so prior to COVID, about 80% of the population is the census definition of Hispanic and or Black. So that's compared to 50% of the total population. So we know this is a burden that is more absorbed by Black community, Hispanic community of New York City. And so it's a tremendous concern, that of what happens when people are falling behind on rent so much, when it's not isolated to particular neighborhoods, but just disproportionately impacts certain neighborhoods. And it builds into this overall concern about what are we going to do when this wears off, when the can has been kicked down the road, when billions are owed in rent, and when it's primarily low income households especially that owe that. This is exactly the issue we are about to face. And the further we push eviction moratoriums as well, we know that this is just a cost that's just being pushed to landlords. And so, as Erica mentioned, even though New York City, obviously a lot of our rent, 2/3 of our population are renters. It's the inverse of the rest of the country. A quarter of our renters live in 1 to 4 unit buildings. So even though we have, a hugely dense city and, far more people that do live in 50 plus unit buildings, still 1 in 4 are living in smaller buildings. And so, 2 people fall behind in rent in a smaller building, that's 50% of rent collection. That is just not something that you can underwrite to. That is going to, push the issues to the lending system, the property tax system. And so again, this mounting arrears issue is of dramatic concern, and it is both a health crisis and a wealth crisis too.
Matt, I want to thank you for your throughput there in drawing those links between the tenants, the landlords, ultimately, the lenders, and then the servicers, the investors, and obviously, given the gravity of what you just outlined and all of the speakers have focused on today, there are implications here, obviously, for neighborhood stability, future affordability, and I don't know if you have any immediate reactions to that, but just wanted to ask if you had any short comments on that.
Yeah, and I mean, this is kind of part of the issue that we're very reliant right now on the census data and estimating and the pulse survey data, and there is what we're trying to do is gain more information on rent collection data and what is going on actually on the rent roll side, and we're actually partnering with an affordable housing organization here in New York to try to capture information on about 20,000 units of mixed income housing, just to understand when are people paying, how are they falling behind in, what's the timing of catching up, try to just get some real-time information. It's incredibly difficult just because of how fragmented some of that information is and proprietary. But what we're starting to see, or, you can see that the CARES Act benefits, the unemployment insurance, was just a major help for people. And we don't see necessarily the impact we would have expected to see without it. But we also see some evidence of falling behind. And one of the concerns too is, collections of rent, whether that's the best indicator, because if we have 100% rent collection, let's say in a building, we're missing out on the vacancies, right? And so concern is, we could have a lot of rent payment that's happening, but if fewer people are living there and paying rent, that's a major concern, and that shifts the cost to the landlords and lenders. And then also too, the effect of commercial income. I mean, you basically see non-payment of commercial income right now. And, this is also, something Randy will get into, but, this is affordable housing, and especially in New York, that a good amount of income is reliant on commercial income. And so, again, these are kind of like the rent payment, like what do we actually see on the ground? I think we're starting to see evidence that that this is a growing, kind of like slowly growing issue, and whether it's a cliff or just a constant kind of growth, regardless, we're going to see losses distributed throughout each kind of entity in the housing system: tenants, landlords, lenders, and everyone else that participates too.
Well, I think that, thank you. And that tees us up so well for Randy's comments and certainly for panel 2 as well. Randy, you represent the small business community. As Matt noted, commercial tenants are really important. We know that small businesses have really been under siege, among others, in this crisis. I'd love for you to enlighten us on what you're seeing among small businesses in Brooklyn, but in the city at large as well, commercial tenants, but also small landlords and property managers who themselves are small businesses. So thanks.
Thank you, Claire, and thank you, everybody, Erica, Matt, and Brian. A lot of what we're going to talk about on the commercial side mirrors the crisis that is building on the residential side. I mean, I will say the one difference is the fact that for many commercial tenants, there was a period of time when they did not have access to their space, right? So they actually didn't have physical access to what they now owe rent on or owed rent on. So there is one distinction there. But for the most part, the crisis, the looming crisis, is very similar. Brooklyn's a small business economy, 63,000 businesses in the borough of Brooklyn. 84% of those businesses have less than 10 employees. Now, they're not all brick and mortar, but a significant number are brick and mortar. And the businesses that we represent tend to be those small businesses, the mom and pops, the independents throughout the borough, both essential businesses and non-essential businesses. And what we started to do in April was really to survey monthly our small business community to basically start to tell the story of what the impact was on the ground as it was unfolding. And we were going to track that over time. And of course, asking the question about rent was one of the significant questions that we've asked since April. So Claire, if we could just pull up the data set and I'll go through it. Great. So thank you, Claire. So on top, you've just got the number of people who responded to the survey. We separated responses by minority and women business enterprises so that we could track separately the impact on MWBEs. You could see in April and May, at the height of the shutdown, we were hearing that almost 50%, sorry, up to the first slide. Yeah, no, the first one. Claire? Yeah. We were seeing that almost 50%, it peaked at 46% of small businesses were indicating they missed rent in May, pretty consistent with April. The number was similar for MWBEs. We also asked about concessions. Well, how many of the small business tenants were getting some type of concession from their landlord? And we saw about 1 in 5 by May were getting some type of concession. June, if you think about phase 1 reopening of the economy, it took place in early June. Businesses were starting to get back online. We saw a little bit of a dip in the missed rent payment. Pretty consistent on the MWBE side. The concessions question, similar, 21% offering concessions. By July and August and then through September, when the economy had fully opened, you did start to see things level off a little bit more. And we started to see, I think, landlords offer different types of concessions. Now, when I say concessions, it doesn't necessarily mean they offered a reduction in rent or they offered to waive rent. It could be they're backloading rent at the end of the lease. It could be they've reduced the actual percentage. They could be they've worked out some other arrangement. There's also some belief that the concession issue may be a bit of an undercount, right? So when Matt talks about the small property owners, the 2 to 4s, by the way, a lot of those 2 to 4s may also have a commercial space on the ground floor, very typical in places like Brooklyn. If they've offered a concession to tenant A and they have other properties in the general vicinity, they may not want that tenant to advertise the fact that they received a concession, and that was sort of part of the deal. So, we have some reason to believe that the data might be undercounting the concessions, but we just can't verify that. By September, we did ask the question about back rent, right? So this is going back to April. And any point along the way, do you owe some sort of back rent? So this is consistent, as we've heard with the data on the residential side. 38%, almost 40% of businesses so indicated that they owed some sort of back rent. 44% of our MWBEs indicated that. And when we dig deeper, just in terms of the sectors that were missing the rent payments, Restaurants and food establishments, top of the list, retail, and then health and wellness. Health and wellness, if you recall, were the last to reopen, and in some cases still have not reopened in New York State. So, that sort of rounds out kind of the who, right? The who in the small business community is missing rents. When did they miss the rents? And what was the difference with respect to MWBEs versus all firms? If we go down to the second slide, we talk a little bit, we did ask a lot about when we talked about the CARES Act funding, especially PP, that should be PPP, not PPE, but PPP program. So one thing I should say is one thing about access, and the second thing is about, was the program structured well enough for our businesses to take advantage of it, right? Those are two very different questions. And I point that out because rent is the highest fixed cost for most small businesses. And if you remember initially when PPP came on the scene, only 25% of the funds were eligible for use for sort of non-payroll purposes, including rent, right? So if you take rent, you take utilities, you take your common overhead costs, and only 25% of that could be allocated. In a high rent environment like New York, it doesn't go very far. Now that was adjusted in July when Congress made the amendments. It bumped that up to 40%. But when our businesses were able to access it also mattered, right? So when our businesses were still shut down, yet other businesses across the country were open, they couldn't necessarily use their PPP effectively. And then in many cases, they exhausted that PPP. If you go down to just, what are businesses telling us are their most important needs? Grants, not loans, real rent relief, and then this smattering of PPE, low interest loans, some marketing support and so forth. But clearly rent relief is sort of top of mind when it comes to the commercial market. Now, very similar to the residential market in New York, the moratorium has been extended to the end of the year. In many cases, that is kicking the can down the road. Although there's at least anecdotally, as we've done 25 commercial corridor tours since phase one reopening, at least anecdotally, we're starting to hear landlords take a little bit more of a practical approach in dealing with tenants, because they're not so sure that there will be, if we can open up for evictions and we start to evict commercial tenants, if there's anybody else to come in and take the space afterwards, right? That's a huge concern for a lot of our commercial landlords. There were already retail vacancy crises in certain commercial corridors throughout Brooklyn prior to COVID. And that was due to oversupply. Oops, and then I just have a cat, sorry, cat just joined me. Cats don't take up a lot of rent, but that's okay. But in any event, there was in certain commercial corridors this retail vacancy crisis, and now it's going to be exacerbated by just the number of business closures, right? And what are we estimating in terms of business closures? This is a very, very difficult number to pin down. The Partnership for New York City threw out a number that a third of businesses may close within 12 months. We're seeing that as pretty consistent. It depends on the commercial corridor. Different commercial corridors have different factors that are weighing on this equation, but right now we're talking 15 to 22% of businesses that have already closed. Sometimes you don't even hear about the businesses when they do close because they don't necessarily need to advertise that, or they're not filing for bankruptcy per se. They're just closing their doors and giving back the keys. So there's a lot of complicated questions and issues with respect to the rent equation. But for the most part, the crisis, just like on the residential side, is looming. And when the moratorium is lifted, if there isn't some sort of policy in place to sort of mitigate the impact, we are going to see significant damage within the small business economy throughout Brooklyn and New York City.
Randy, I want to thank you so much for that. And of course, those great issues facing small businesses, of course, translate into significant employment losses, and that is a great concern. I think you teed us up perfectly to transition to the second panel. I want to thank all of the panelists for laying out the issues facing renters, landlords, and ultimately neighborhoods. I'm going to turn over to Mark Willis, who'll kick off the discussion about options for relief. Thanks, everyone.
Okay, Claire, thank you very much. I assume you can all hear me. That was a great panel. I think that I was going to say it's a great setup, but actually it's not great news. So maybe that's not the right word to use here. We have a terrific panel here to talk about options for relief, remedies, costs, and risks. Let me just very quickly introduce them. Rafael Sestero is president and CEO of the Community Preservation Corporation, a leading not-for-profit affordable housing and community revitalization finance company. Andrew Howard is leader of household and regional policy, research and statistics at the Federal Reserve Bank of New York. I hope you all know what the Federal Reserve Bank does. Charles Ostroff is senior vice president, multifamily chief credit officer at Fannie Mae, also another institution. We'll learn a little more about what they do, but I think you're all familiar of the role they play in home finance and apartment finance. And Abby Wamimo, who is a co-founder of Isusu, which is a company that works on rotational savings and credit building for households. So let me just thank the panel and let's dive in. We don't have a lot of time here. I want to, before just pull out a few quick facts here from the earlier discussion, and there's very little for me to add here, but it's important to note a couple of realities here that this is a bifurcated crisis. We're in the middle of a health pandemic as well as an economic crisis. There are people who are continuing to do just fine, and there are others who have lost income, lost a job, and worst perhaps is lost their health. And that and those folks and businesses, I guess, are not evenly spread across the economy, across the population, across neighborhoods, and across individual buildings. As Matt pointed out, you can have in a four-family building, one tenant is 25% of the rent, or probably it's a third of the three rental units. So we're now also experiencing the end of federal income supports that supplemented unemployment insurance and gave one round of universal payments. So that is complicating a world where we don't really know the end of this pandemic. So there's great uncertainties. The purpose of the panel is to explore, and I hope I've covered them all, fiscal, financial, and regulatory issues, but there are other options that can provide relief for renters, homeowners, and other residential property owners. So we're going to explore what actions the government can take here as a source of financing, a provider of public services, financial regulator, and more specifically, we're going to also be thinking about the financial sector's role here as lender, investors, to real estate businesses and consumers. So we have a lot to do, and I want to move quickly to get the panel involved. So Andy, as I just pointed out, income supports are out there, but what else has the government done, and what are we thinking about how that is working?
So thanks, Mark, for that question, and I'm really happy to be here. I should start out by saying that the views that I'll express today are my own, and not those of the Federal Reserve Bank of New York. To be careful with that. So let me take a step back, if I could, to and work my way back to the question you directly asked. The thing I want to start with is what I consider a little bit of a puzzle, and some of the previous panelists mentioned this. And that is that when you look at survey data, you can find that a reasonable proportion, pretty reasonably high proportions of people say they expect to be able to make the rent next month, even in spite of a very severe economic crisis. And so, if you ask them about the next 3 months, how likely are you to miss a debt payment or a rent payment? Large numbers of people say they expect to be able to make those payments. They don't expect to miss a payment. And one of the things that we've learned over the last few months is what's behind that. And I think that's an important thing to bring out, and it'll be helpful, I think, to get at your question, Mark. So we have a survey here at the New York Fed called the Survey of Consumer Expectations, and it allows us to sort of see that behind what I would describe as a lot of optimism about ability to make rent payments in the future is significant optimism that there will be continuations or even expansions of the generosity of policy interventions that we've seen up till now. And so people who are confident that policy will continue to support their housing consumption or support their income are the ones who are really optimistic that they'll be able to continue to make those payments. And conversely, people who don't feel that those policies are likely to continue are much less confident in their ability to make those payments going forward. So what does that tell us? Well, it tells us, I think, that these policies that have been put in place over the last several months played a very important role in keeping us in a reasonably strong position, or weakening for sure, and I'll come back to that, but in a reasonably strong position over the summer and into the early part of the fall. Now, I want to point out, and this is something that Erica pointed out in the early panel, is that there's a huge heterogeneity between low-income households and non-white households versus higher-income households and white households. Those non-white households, for example, are twice as likely to say they expect to miss a rent payment over the next 3 months or an auto payment. So these are really big differences in the stresses that different kinds of households are experiencing. But coming back to the role of policy that you pointed to begin with, Mark, over the summer, we saw household balance sheets really put in a fairly good position because of the income supports that were offered under enhanced unemployment insurance and the stimulus payments. Those household balance sheets, though, are starting to come under stress. Households have been able to put away some money, save to get them through the summer, and as I mentioned before, many expected that there would be extensions of these policy interventions in the fall, and that's allowed them to keep going and keep feeling optimistic about what's to come. So I think an important part of the outlook and what we have to think about as coming up for the fall will depend critically on the kinds of policy interventions that we're going to talk about today. So let me stop there.
So what if I may, Andy, what policy? The earlier group talked about some of these. So talk a little bit about forbearance and eviction, moratorium, and this idea of kicking the can down the road, and what that means in terms of maybe a cliff or not, and I think you've already started to indicate we're really talking about just some segments of the population. Some segments are actually doing quite well. So how are the policies that we have well focused here?
Yeah, so that's a great question, and maybe the way I could frame it is drawing on the earlier conversation. I think that was really informative, and the way you just put it, I think, leads to this. So I think about this as there's sort of three kinds of policy interventions that one could imagine. One is sort of a grants policy intervention where essentially we're providing income support, mostly likely to tenants. The most targeted of those would probably be unemployment insurance, and we had the extended and enhanced unemployment insurance in the early part of the crisis. That's pretty well targeted, and it's not a loan. It's in fact a payment that one can keep. Stimulus payments, less well targeted, but also a grant in some sense. The second kind of program is a lending program. And I think of forbearance as kind of a lending program. If the landlord is sort of lending to the tenant by not collecting the rent right now. But as many people have already pointed out, and we should talk about, that creates a debt which is expected to be paid back. And over what time frame is a crucial question. Another example of that is servicer loans to borrowers. The mortgage servicer may say, you don't have to make the mortgage payment for the next several months. That's another kind of lending program. And then working in conjunction with those are what I would call regulatory programs, where we forbid evictions, for example, or forbid foreclosures on owner occupants for a certain time period. And those two combined, lending programs and regulation of evictions, It's sort of been the main way we've handled the rental crisis so far. And as it's clear that those don't solve the crisis, they only push it down the road. So I think that's important. I would say one more thing if I could, and that's there's a big difference in the way these programs work for owner occupants versus tenants. And in particular, you know, when you think of an owner occupant and offering them a loan forbearance, a mortgage forbearance, we could say you'll skip the next 6 months of mortgage payments and we'll tack those on at the end of the loan. And as an economist, the way I think about that is that's incentive compatible in the sense that the owner occupant has a strong incentive to pay that loan back and will presumably have the ability to pay that loan back over a long period of time. It's a little bit of a different situation when you're trying to lend to tenants because they are not expected to be in the property for a long period of time. They don't have any equity in the property that is at risk if they don't pay the loan back. So that's a much different situation. And I think that's an important distinction to keep in mind.
If I may, Andy, add to that, if the forbearance for the homeowner means they're going to make the payments after the end of their 30 years, when they don't have any more mortgage payments, it's not being added on to a monthly burden. It's just continuing a monthly burden. So we're going to talk now. I think this will become important in thinking about the multifamily lending business here. So let me turn it to Raphael, and I'll go back and forth here a little bit with Charles as well. But why don't you tell us a little bit, Raphael, what are you seeing out there from your customers, the owners of these properties? What are their experiences out there in rent collections and whatever else? You're on mute for some reason. Okay, thank you.
Thanks, Mark. I appreciate being here with all the panelists. You know, look, Mark, I think the reality is that the interventions that came with the CARES Act and other things have effectively kicked the can down the road from the perspective of what we're seeing in our portfolio. We service about $3.5 billion worth of mortgages primarily in New York. The majority of our loans are to small property owners. And, you know, our delinquency rate his pre-pandemic was less than 1%. It's now up, pushes up close to 3% delinquency. And we've got about 7% of our portfolio actively in forbearance today. So we have that you know, about 89, 90 loans where we're not receiving mortgage payments, and we've forbeared in partnership with the investor on those mortgage payments. You know, early in the crisis, we saw rent collections in the 90%, 90+% category from self-reporting from owners. Since the unemployment insurance lapse and the stimulus payments were exhausted, we've seen that drop down to about 75% rent collections. So we're still braced for a coming wave of owners who are unable to make their mortgage payment unless there's more dramatic action taken to intervene in the rental housing market.
So I just want to make the distinction here, and then I'll actually ask Charles to also comment on what he's seeing from Fannie Mae's perspective here. But what I'm hearing is that while these federal income supports were so strong, it sounds like rents for many buildings were holding up the rent rolls. That it sounds like now we're seeing something, which is where you refer to, we're not dealing with this problem now, we are kicking it down the road.
The other thing I would just add to that, Mark, is that we're also seeing our delinquency at the beginning of every month. Our delinquency is in the double digits. We're in the 12-15% delinquency, and then by the end of the month we drop down to below 3%, because I think owners are trying to figure out whether or not enough rent is going to come in for them to be able to make their mortgage payment. And I think these are all early indicators of a looming crisis that we all need to prepare ourselves for.
Right. And tenants may be trying to balance also what they're paying bills on.
That's exactly right. Sure.
Right.
Yep.
Right. So Charles, what can you share from your perspective here on what you're seeing?
Sure, Mark. I'd also like to thank everyone on the panel and also for being invited to be on the panel. Chief Credit Officer for Multifamily of Fannie Mae, and just so everybody's aware, we loan on properties of 5 units or greater. So I know there was a big emphasis as it relates to 2 to 4 or single family rentals. That is not the space that we lend in. So our perspective might be a little different than the first set of panelists or other people that are tracking this information. As far as our portfolio and what we're seeing, I'm going to echo a couple things that Raphael had said when we entered into this forbearance. And again, due to a quiet period, I could only talk about a portfolio through the second quarter of this year. But
forgive me, Charles. Charles, quiet period is a regulatory requirement, right? So it just means you can't talk about something before they've been officially announced. So everybody may be aware of that technical thing.
Thank you for that. Thank you for that clarification. But what I would say is that we were very focused on July 25th. And July 25th was the date where the employment stimulus was going to expire. And we weren't quite sure. We said, okay, fine. We think that August, we might see a slight drop off, but we're really going to focus on September and October with our borrowers and the operation of our portfolio. We have not seen within our portfolio as far as from a forbearance perspective. So remember, Andrew had mentioned one of the tools, which we talk about, a tool of the lender, is forbearance, and that's for the borrower to forbear their payments on the loan, and thereby for the first 4 months, it's up to the lender to make the payments. And then after that, the lender can ask for reimbursement from Fannie Mae moving forward. But remember, it's a tool to where we're going to forbear on the loan, and as part of the forbearance program from not only the CARES Act, but from what we call Forbearance 2.0, that there is an eviction moratorium on those borrowers that do take that forbearance option. So again, a tool to lender, something from a perspective of the residents. The residents are in a sense forbearing their payments, just like the landlord is forbearing, but those payments will accrue. As it was brought up in the earlier panel, they're still going to owe that rent. But what I will say, as part of our forbearance program, it cannot be asked for in a lump sum. They have to enter in some sort of term payment program. But again, what we're seeing is strength of our portfolio. Remember, greater than 5 units, and one of the things that we attribute certain things to is as it relates to the operators, and I do believe that there's more pressure on the smaller operators. I do believe that there's more pressure in that 2 to 4 unit space and that single family rental space, and that's a lot of what you're seeing and reading about. Remember that, whether it's Fannie Mae, who I work for, or there's another GSE out there somewhere, their market share, we don't lend to the whole world, and we are restricted to lend to 5 or greater units.
Right. I'm glad you brought that up because you do have a small loan program, so I'm not sure whether you can comment on whether you're seeing something different in the ones there. But what you referred to single family, again, is jargon here, forgive me, is 1 to 4 families. So you're seeing
that's considered a single family.
I get it. Right. So that's not something that you can comment on because that's not your side of the.
Well, what I can comment on is that what I had mentioned to people as it relates to the 4 S's. We saw pressure in seniors, pressure in student, pressure in small, and then stress. And what I mean by stress is that those properties that saw stress prior to COVID are more likely now to see that stress. So that's the pattern. Everybody asks me for is there a theme out there of your operation, your portfolio? The theme is those properties that had stress prior to COVID are really the ones that are coming in asking and needing help right now while we're dealing with COVID.
Right, right. So I want to go back to you, Raphael. Obviously, the panel is supposed to be thinking of options and what are some creative ideas here. I think you've been involved in a program called New York Forward. Can you tell us a little bit about that and what the lessons you have learned here about this a different approach to try and be helpful to the owners of these properties?
Yeah, so New York Forward is a program that was launched by the state of New York that partners CDFIs and financial institutions, community development financial institutions like CPC and commercial banking institutions together to provide low interest, flexible loan product in Andy's framework. This is a loan tool to both small businesses and landlords. So the majority of the program, New York Forward, is for small businesses, and that's operated by a set of CDFIs that focus on small business lending. CPC as a housing lender has been running and managing the New York Forward program for small owners. We have seen an extraordinary number of applicants. We've seen almost in just the first week, we saw, 500-600 applicants for the program. Look, I think what we have learned is that loans have limited acceptance in the world, because I think owners understand that everything right now is a loan. If they're forbearing, that's a loan they got to repay. If they're in a deal with their tenant and their tenant isn't paying, they have a lending relationship with their tenant, and they're reluctant to get into another loan program. But we have made 32 loans to date. The average loan sizes are small. These are all for small property owners. We're about 40,000 per loan, and we continue to get applications in. And I think to Andy's point, the lending piece of this is one tool, but in my opinion, it is not the tool that is going to ultimately help us through what is this looming crisis.
Right. And I believe you mentioned it comes with restrictions, which
it does. It comes with it. Yeah, there are income limitations, so that
which you would think government would want to impose.
Right.
Yes.
The average rent can't be any more than 80% of area median income. There cannot be. You have to agree not to evict tenants. So yeah, it's something that comes with the kind of restrictions and regulatory hurdles that you would expect from that kind of program.
Right, and been well received by all of the landlords who've been applying. So I just want you to make that point as to.
Look, it has been something that has gained a lot of interest and a lot of traction, and it is one tool, and it has been effective for a certain category of owner. Right.
You couldn't see me. I was trying to make the opposite point, which is that makes it even harder. It's not just a loan, but it's a loan with restrictions and government involvement, which a lot of small landlords may not be excited about. I don't know whether you want to comment on that.
Well, look, I think small owners who are not used to dealing with government are generally less willing to get into the mix with government. And if it was a PPP style forgivable loan, if you met certain hurdles, I think those kinds of programs could be things that we should be thinking about in the future. But look, at the end of the day, my view on this is that in 2008 and 2009, the federal government took dramatic action to bail out entire industries. And that dramatic action launched the economy forward for a very quick recovery that people didn't really expect after the Great Recession. In my view, the rental housing market in particular is going to be in the need of a very similar kind of dramatic action. And that action is going to have to be both for tenants and for owners, because this backrent issue is not going away. And it's not something that anybody is going to be able to figure out how to solve.
You mentioned PPP. what are your thoughts on what a PPP for landlords would look like? And Charles, I'll come to you in a second too on that.
Look, I think a PPP for landlords would be a program that would deal with this issue of back rent. It would deal with the fact that for some significant period of time, owners haven't been receiving rent from tenants. They've gone into payment agreements. They've forbeared on the rent. They haven't been able to evict, and they're accumulating arrears and significant arrears. And this is, by the way, across all stocks, whether it's the capital A affordable housing, low-income housing, tax credit type portfolios, or small building owners, or even large property owners. Those arrears are mounting. And so to me, a PPP kind of program would come with, would be a program that would pay those back rent. And you would, that loan would be forgiven over time if owners met certain hurdles around not evicting tenants and keeping tenants in place in their units.
And presumably forgiving that rent under whatever circumstances.
Right. Absolutely, because they were getting it paid through the PPP loan.
Right. Charles, you have some thoughts about that, or other ideas that you might suggest here, that programs that might make sense?
I have some thoughts because, I definitely thinking the same way that Raphael's thinking, whereupon, the relief, remember, again, if the resident's not paying the landlord does have an obligation to a lender, right? And then the lender in turn to their investor. So it's a chain, and the chain can't be broken. And if the chain's broken, then there is an issue. And the issue is, whether the resident is being evicted or whether the property owner is losing their property or being foreclosed upon. So, the money, if it were to go directly to the landlord, is definitely going to have strings attached. And it's going to have to, whether it's a calculation of rent that is due from those residents, and then, okay, fine, we're now going to zero out that resident's back rent. And then the landlord's held a certain level of restrictions. And, I think, Mark, you and I discussed, the Hope Note concept, where there is going to be some level of an obligation that could trigger. It would be more along the lines of what I would consider soft pref equity, as far as from a repayment standard, or even if a financial institution was looking for payback, just like adding on to the back of an individual homeowner's property, as far as whether it's payments, whether it's refinance, whether it's sale of property, where that equity was paid back. So there definitely has to be, if you're going directly to a landlord, has to be strings attached that protect that underlying resident who did have an arrears, because what you're doing is you're balancing that out. Other than that, it's in the form of, as Andy pointed out, an unemployment or employment stimulus. To providing that stimulus to the individuals getting a check so that they can pay their obligations, and thereby it goes back up the chain. But you're still going to have to deal with the arrears of those tenants and how you make up for that, because right now, the longer the clock runs without some level of a stimulus, the greater that it is. And it's a population that is historically living paycheck to paycheck. And once they fall behind, you and I both know they're not catching up.
Yeah, Charles, we're going to move in a second here to the consumer side here. Before I do that, I think you said that Fannie Mae's portfolio in multifamily is about 29% of the market. So that means 71% of the mortgages.
I did not say 29%.
Well, whatever you said, you can give the figure. But there's a substantial amount of other players here providing credit to multifamily properties.
Correct.
Right?
Correct.
And are there some lessons that you have seen here, or some things that are unique and that Fannie and Freddie can bring to the market that may be more difficult in terms of the secondary market, bringing in investors, making the accommodations here? Your forbearance, as you said, I think yesterday in more detail, for every month you forbear, they get 4 months to pay it back. So right. So if you only had 1 month that you needed it, the next month you pay 1.25 times your usual debt service. But obviously this thing's going on for a very long time. So we're talking about very high repayment issues here. What are you thinking this means in terms of the rest of the market, of the secondary market, not the very special stuff that you're doing?
I believe, again, you talk about lessons learned in the rest of this secondary market. You're going to have to look at what you have in front of you. And what I mean by that is, was there equity in that real estate prior to, if you want to say, the forbearance of that payment and looking for the payment back, meaning is that there's something at stake? Does the individual or the borrower that you're doing business with, what are they protecting, right? So if a property is underwater, then it doesn't pay for Fannie Mae or to in a sense enter into that forbearance, because there's no incentive for somebody to pull themselves out of it. As far as lessons learned, one of the key lessons, and I know Raphael will back me up on this one, is property condition. If you're seeing an issue with property condition, you're more than likely in hard times going to see an issue with the property performing, number one, and number two, there being something left. And we have somebody in our asset management group that talks about you don't want to be left with a bag of bones. That basically it's the obligation of that landlord to keep that property up, to ensure that not only that there's paper equity but real equity when it comes time to refinance the property.
I want to flip that around. So in the sense that if somebody isn't able to pay the debt service to you, probably they're having trouble maintaining that property as well. So part of the long-term crisis of this thing is what's going to happen to the housing stock if we don't help and make it possible for the landlord to pay their debt service or whatever they have to and properly maintain the property. So,
sure, and with all the issues that we're having, COVID-related, everything else, we are getting eyes on properties, and we're calling them drive-bys, meaning that we set out circles of, I'll call it 2-hour radius, 3-hour radius of driving for our employees, and those that only feel comfortable. It's not a requirement, thereby to get eyes on these properties to ensure that they're being kept up. And then where we cannot cover, we are contracting with subcontractors to go out to BRIs, trusted subcontractors that we worked for in the past. So it's something that we're aware of, something that history has taught us, and something that we knew we needed to get back into the market to make sure that it's being covered.
So let's go to Abby and the consumer here, or the homeowner, or the renter, or the household that we've talked about here, who may be suffering from the disease itself, from unemployment, from all the other problems that are coming together in this pandemic of economic health equity. So what are you seeing, Abby, with regard to the balance sheets of lower income households? And I think Andy may want to weigh in a little bit on this too, but give us a sense of what you see going on out there.
Absolutely. Thanks a lot, Mark. So from what we are seeing, naturally, is consistent with data that's been out there. Early on in the pandemic, savings was incredibly high. And then 2/3 of that, around 70-80% of that eroded in August. So what we are seeing is we have proximity to the data, cash flow information, real-time credit score information, and then rent ledger. In addition to what we do on the savings side, the biggest business we actually run is capturing rental data, reporting it, and doing predictive analytics for large multifamily housing providers in 40 states and 500,000 units around the country. So given that context, what we saw early on in the pandemic, and the average household on our platform earns just less than $38,000. So folks that are chronically affected by this crisis. What we are seeing and saw earlier on was 70+% of the household won't be able to meet this largest expense, which is rent. And the question for us from a practical standpoint is, what do we do about it? We understand the rhetoric about the PPP loans and how complex that would be, very, very difficult to get access to. So what we did was essentially create micro loan programs, 0% interest loans, and then lend to consumers or renters. And then that money gets paid to the landlord directly. And then we work with the renters for them to pay back, give them a loan moratorium for 3 months, and they pay back over a year. That has proven to be a very, very instrumental resource to the landlord, number one, because cash flow is coming in with no strings attached. And then number two, to the resident, whereby they're getting this cash with low interest loan and then giving them 3 months in advance. And that, right?
Go ahead.
Yeah, I think that has led us to just strongly believe that, when you see a little bunch of loan relief rent relief programs kicked off, particularly in New York State, places like Minnesota, $100 million respectively, there's this administrative burden to actually get the cash out. On average, our company at Isusu, we're getting those cash out to the resident and the landlord in less than 2 weeks. So that's
how does this going to work when it goes on for 3 months more and 6 months more? Are you concerned about that, or are you ready for that?
Yeah, it's a fantastic question. So we're dealing with a symptom of a larger disease here, right? Which is pure point blank period income inequality, right? Predominantly amounts of people that are dying from this crisis are, Black and Latino people. The data from the first panel was very clear on that.
Sure.
The people that will be affected when it comes to, eviction crisis will be Black and minority communities. So when we think about the span of what's going to happen, the solution is really two-pronged from our perspective. Number one, what is the stopgap measure we need to put in place from a cash flow standpoint? So 2 things is happening, right? Residents, we get access to resident ledger. So we get access to the real page, the Yardi, the Resmont. We see all that data real time, right? So from a collection standpoint, we're seeing the behaviors of residents. So the solution we are advocating for, and we think is probably going to have legs, is get the cash to the landlord as fast as possible, so you avoid things like late fees, court fees, and other additional costs that goes to the residents, because that just compounds the issue. Number one. Number two is bring a group of lenders together, CDFIs, credit unions, where majority of this low to medium income people bank, right? And then talk with the Treasury to determine the cheapest interest rates possible that these people can lend from. And number three is the policy level. When the crisis hit, we gave Wall Street $2 trillion in free interest loans. Why are we not doing the same thing to consumers, right? Let's create a loan loss reserve fund of $1 trillion, right? People can borrow, whether they need that cash directly or institutions like ours can give money to the landlord and pay on behalf of the residents. And then they have that promissory note where we can go cash it out at a CDFI. That's a practical way. I am very, very skeptical from a big PPP approach, giving it to the landlord. There's going to be a string attached, but let's get it to the consumer somehow where the landlord benefits strongly, but then we can go get the cash back as independent players. That's one of the practical ways, because the current approach isn't just working.
It looks like, Andy, you want to weigh in here. If you do, feel free.
Well, I think I want to say 2 things, and then maybe get some others to join in as well. First of all, the data that Abby's describing that he has on these residents is from a public policy and a researcher's perspective. I think it's so crucial that we have some window into this part of the world, into this market, which is very, very limited. If we were talking about owner occupants, we would have so much more data available to us on their mortgage payments and when they missed the last one and how they did 20 years ago on their mortgage. So this is a completely different landscape, and I think it's important to know what Abby's doing, and I think it sounds great. On the loan, the PPP versus the other kind of approach to providing liquidity, if you will, to landlords. I mean, my thought here is maybe a little more aligned with Raphael, but I'm interested in hearing others' ideas. These are small businesses to a large extent. And so, they don't have a lot of employees typically, but they will have significant expenses. And to the extent that we can think of them in that, the regulation that we would put on them, if they were regular small businesses looking for PPP forgiveness, would be that they maintain their payrolls, et cetera. Here we would say, well, yes, we want you to maintain your payroll, but more importantly, first and foremost, we want you to offer this kind of forbearance on rental payments from your tenants. To me, that sounds like something that would be worth considering, but I understand, it's different. It would be complicated. But the forgiveness aspect of that, the fact that it's a loan if you don't comply with all those strings, so to speak, but it becomes a grant if you do. I think that's quite appealing, and that keeps incentives aligned in a way that I think is valuable.
Right, right. So Abby, I'm worried. I don't know if anybody else wants to comment. We're getting short here, so I'd like to stay with Abby for a second. But if there's somebody else that wants to make a point on the PPP, PPP is basically a grant, and it has or it's a loan that can be transferred into a grant if you perform certain conditions. I think that's how we're thinking about it as a general approach here. So, Abby, what about credit scores? What about bankruptcy? What do we need to think about here in terms of the impact on those people that I pointed out from the beginning who are suffering, right?
Yeah, great question, Mark. So when we think about credit scores, it's very interesting because credit scores are, as compared to last year, is actually on the rise, right? Folks, there are more people with 700 credit scores than we've ever seen. So what happens to the concept of underwriting risk and the true reflection of the risk we're trying to underwrite? So it's been consistent with what we're seeing from a larger data set and consistent from what we're seeing for 250,000 to 500,000 people, give or take, where we have the data. What this brings is, how do we actually collect an additional array of data to better underwrite risk? So where we see the industry going to, from financial institutions, mortgage lenders, insurers, is the credit score comprehensive enough, right? Do we have opportunity to add other alternative data to that data set, or do we need a tapestry of data to underwrite risk? A classic example is, you have the credit score, it's tried, it's proven, we understand risk, we can run a whole bunch of models on it. Then what about cash flow information, right? We have a lot of startups out there and institutions that can get bank account information at a particular point in time and look back over 2 years. That's number two. Number three is, when we think about, rental information, which only 1% of rental data is just added to the credit scores today. How can we capture rental data at large to be able to underwrite risk? And another thing that's been left out is 401k information, like long-term savings. People can draw down on that kind of debt. We don't have a comprehensive view on all this data sets. And that's something I believe like underwriters and other financial institutions will be looking to have. And that's some of the interesting work we are doing at ASOSU.
All right, right. I'm going to turn this over to Claire in a second. I just want to make a quick comment here. I think if banks are forbearing, they are not allowed to report that as on the credit scores. I think there's a piece of that because we haven't gotten rid of credit scores yet. You have a great idea how to make them better. So this is another thing, is how in the interim we can help protect people who are in distress for no fault of their own. And make sure they aren't harmed in the credit system, as you were talking they could be.
Yeah, Mark, if I can add, I think the CARES Act actually, accounts for this. There's something called a disaster code, which COVID is a classic example of. If you have a Hurricane Harvey or any major event, the credit rating agencies have a disaster code that you can key in not to affect the consumer. So that has been what has been used across board.
Good. Okay. I think our time is up. I see Claire has appeared here. And so it's time for me to thank the panel. You're all terrific. I really appreciate it. And I think we have raised some good ideas here and really looked at the crisis as we're now facing it. So back to you, Claire.
Thanks so much, Mark, and thank you to all the speakers on today's webinar. I want to thank the Furman Center at NYU for their collaboration on this important event and for teeing up so many of the issues that we touched on today. Thank you for the rich ideas and suggestions, particularly in the second panel, but also the first panel for setting us up. A recording of this event will be available on the New York Fed's event webpage shortly. We encourage you to stay engaged with the New York Fed, follow us on social media, and be on the lookout for future events. Thank you for attending today, and we'll officially close this webinar. Thank you.